Good morning and welcome back to Almus Market Mornings. Now, as we get closer to the Federal Reserve's interest rate decision, investors are having a realization that assessing a path for the rates beyond this week is going to be tricky. Every meeting, we are observing more dissents, and going by the speeches by various members within the Fed, it seems future rate path will be tricky to determine, and that's primarily why we have seen this rise in yields across the DMs. US 10-year is trading near levels seen in September. Yields in the EU have also seen a big jump, with the 10-year trading near levels seen in March. Japanese yields are in a parabolic move higher. The rate path overall remains tricky to determine during this period. Good morning, JK. A bit of support for the dollar being seen because of the yields. What's your thought on this?
Good morning, Swaraj. I think dollar is not major moves. It's all within the range. Yes, yen almost touched 156. There, of course, the combination of higher dollar yields as well as the very large magnitude earthquake that hit Japan. So that led to some defensive trade of selling yen. However, currently, reports indicate that there's no major damage, although authorities remain cautious. So, otherwise, now yen is also slightly retraced. Now, as you said, the ahead of FOMC meeting where the rate cut by Fed by 0.25% is almost 90% discounted. Uncertainties remain about the future policy because, first of all, there is a huge divergence of views among the Fed members. And we do not have updated information about the economy so far, particularly on the employment and inflation, which are key for Powell's assessment, as well as the members to get their views. So the dot plot, which will come along with the Fed meeting tomorrow, will probably be something which will be very difficult to analyze. Even the members would not be very clear what to put in as their views going forward. So we need some more time before we can assess how things will move forward. But in the meantime, yields have been surging. Now the yields are surging while the monetary policy is expected to ease in the Fed. Is something to take note of. Although yesterday we had also mentioned that the the policy rates in various regions are possibly bottoming out, and the next moves could be higher. And yesterday, in fact, one of the influential members in ECB actually mentioned in as many words that the next move could be a hike, although he's not sure about the the timing of the hike. So they are also concerned that the inflation could be bottoming out and it can move higher. They are also positive about the growth in the euro region. Then of course we are seeing expectation of huge spending by the German government for their infra and defense. In fact, there has been a renewed stress by President Trump that Europe has to meet its own defense spending from its own resources, and not US is not going to fund it. So we are going to definitely see a spending binge from Europe in the coming days, and the yields. It's not surprising that the yields in Europe have gone up. We all know that Japanese yields have been moving up again because the new government in Japan has planned to spend as much as $139 billion equivalent for supporting the economy. So we everywhere, and the problems, or rather the issue of high fiscal deficit and debt in US is already very well known. While there is no clear pathway defined for reducing the debt, the every year we are seeing fiscal deficit of 1 to 1.5 trillion being added, which again they have to raise resources from the fund. And at a time when we are hearing more and more central banks reducing their holdings in the US treasuries, how the government will fund itself is going to become a big issue. While things look somewhat calm currently, of course it is also the year end. I am seeing the next year possibly markets focus will increase on how the fiscal and the debt situation will evolve, and possibly some market players are preparing themselves by selling bonds and not holding the long-term bonds. Therefore, the yields are definitely on the higher side, and this is going to be possibly from the dollar perspective supportive for the dollar, but it's not so it's not going to be very intense because the yields in other regions are also going up. It all depends upon who is the worst affected. Then in my view, dollar and yen will be the more vulnerable currencies compared to the others. There are some regions like Canada and Australia where the yields are going up not because of fiscal but because the economy is showing some strength. Last week we had very big jump in the employment, new employment in Canada, and unemployment rate came down. Even in Australia, inflation is slightly higher and employment was better. So all this leading to some of the regions. And in Europe, of course, yesterday we also had the German industrial output, and that showed a very strong jump. Both on the month-on-month and year-on-year. So so long as the other regions perform better, now dollar could fall because of the improved situation in other regions. Therefore, this yield play, which can become a big one in the coming months, is not clear, as to how things will play out. But definitely, if there is a very large sell-off in the bonds, it could affect all the regions, and then particularly in the EMs, it can become an issue because wherever there is a dependency on capital flow, that can get affected. Yesterday, one of the more significant development was also the Chinese trade data, which now it has topped 1 trillion in the first 11 months of the year. And for a month of November alone, the surplus has reached 112 billion, which is the third largest on record and well above expectation. And now this is all happening at a time when the US imposed very high tariffs on China. Although their exports to US itself slumped by 28.6%, there seems to be a huge amount of diversification of their export destinations that has helped them to achieve a very good trade balance. Of course, the yuan has not reacted much to it because we all know that yuan's moves are controlled by the central fixing by the Bank of China, or rather the Central Bank of China. However, with the dollar slightly stronger, today's fixing is also slightly weaker for the Chinese one. But overall, I see that we are seeing the yen, rather the yuan, somewhat on the stronger side relative to where it was about a month back. So overall, dollar, I think, sits on its hands, awaiting what Powell will say tomorrow. Things are clear as far as this meeting is concerned. If there is no cut, it will be a big shock to the market, but that is very unlikely. But what the dot plot will say, what Powell will say in his press conference, these are going to be very big determinant. At least the last move of this year will be based on this. And of course, we also have the Bank of Japan meeting on 18th and 19th of this month. As for the rupee is concerned, traded closer to 90.30. But seems like market is a bit hesitant to buy the dollars at these levels. The carry cost on the overnight long positions in the dollar rupee is also higher. It could be somewhat deterrent for carrying longs by the traders, and also some exporters are seen taking advantage of move to 90-20 plus. And of course, the premiums also being somewhat well supported. I think exporter activity is also adding to some support for the rupee. Although FI number continues to be negative, for the first week of December, we've already seen over $1.5 billion of outflow. And the stock market, of course, in Indian stock market yesterday was again on the weaker side, while all other markets remained well supported. So we are going to have some volatile period. Today we will have, of course, the JOLTS data, which will give the picture for September and October. Although it is still a backdated data or backdated picture of the US economy, but it's still better. At least we are getting a picture up to October. And of course, we'll await updated numbers for the November. So all in all, I think a lot of haziness, but some concerns are visible on the fiscal and the bond market side. Thank you.
Thank you, Jake. And that's the basic theme that we are going with. A lot of fiscal uncertainty because of the spending across all the developed markets, and that's keeping the yields quite elevated. This is also coming at a time. If you look at the U.S. yields, U.S. is expected to lower rates, but the yields are moving higher. I mean, that's basically sums up what essentially markets might be thinking. When it comes to other significant developments, the Chinese trade data, it topped $1 trillion in surplus for 11 months. And even though exports to US slumped, but they have diversified to other export destinations, and that's something significant. Japanese yields continue to move higher. They have been hit with the earthquake, so yen trading slightly weaker on that front, and also on the back of rising US yields. When it comes to rupee, we traded closer to 90.30, but as of now, it seems like the momentum is sort of dying down. Investors not very confident to buy dollars at these levels. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.